If you're nearing retirement and assume your taxes will go down once your paycheck stops, you're not alone. But there's one item that can catch people completely off guard. That's your Medicare premiums. They're not always predictable. In fact, one recent retiree we spoke with saw hers double without warning. The reason? Something called IRMAA. And if you're not planning for it, it could quietly cost you thousands of dollars per year if you're not careful. I'm David. Welcome again to the show. And today we're unpacking how IRMAA works, why it matters, and what you can do before it shows up on your tax return. So you may be asking yourself, what is IRMAA? IRMAA stands for Income-Related Monthly Adjustment Amount. And here's what it is. It's a surcharge, an extra fee that Medicare adds to your Part B and Part D premiums if your income is above a certain threshold. Now, most people on Medicare pay a standard premium for your Part B coverage. And as far as 2025 goes, it's about $175 per month per individual. But if your income is too high, Medicare says we're going to charge you more. And this is a surprise for a lot of people when it gets to retirement income. And here's what the 2025 brackets look like if you're a married couple filed jointly. Below $206,000 in annual income, you pay the standard premium, which again is $175 a month. If you're between $206,000 and $258,000, your premiums go up. Now we're talking about $250 a month. As you keep going higher in income, the Medicare surcharge goes higher as well. At $310,000 of annual income, you're over $300 a month. And at the highest tier, which is $750,000 in income, you're looking at nearly double the standard rate. Now, the same thing happens with your Part D premium, your prescription drug coverage. It has its own IRMAA surcharge. So here's the point. IRMAA is income-based and the thresholds are lower than most people think. Now let's talk about the 2-year look-back rule. And this is the part that really blindsides people. IRMAA isn't based upon your current income. It's based upon your tax return from 2 years ago. So if you're retiring in 2024 and your 2025 Medicare premiums are based upon your 2023 income, when you were still working full-time. So let's talk about a hypothetical example. We have a hypothetical client, let's just call her Jane, who retired at the end of 2023. In 2023, she made about $250,000 from her job. That was her last year that she was fully working. She retired. So in 2024, her income dropped significantly. She thought, okay, my Medicare premiums will now be normal. But when she signed up for Medicare in 2025, which is based on the 2023 return, she got hit with an IRMAA surcharge. Her Part B premium jumped from $175 a month to double, or $350 a month. Her Part D went from $40 a month to $75 a month. That's an extra $4,000 a year in Medicare costs just because of that 2-year look back. And here's the kicker. There wasn't anything wrong with what she did. She just didn't plan for the IRMAA surcharge. So that's the core issue. There's a lag in the system. You retire, your income drops, but Medicare is still looking at the year you earned your last big paycheck. Now, the good news, and there is good news, is that understanding gives you leverage to plan. All right, so now let's talk strategy. There are several ways to either avoid or minimize your IRMAA exposure. Number one, timing your retirement. If you know you're going to retire soon, think strategically about when you actually retire. If you retire January 1st instead of December 31st, your final income is lower. That changes what Medicare sees 2 years down the road. Here's an example. If you're going to leave your job anyway, sometimes retire in Q1 is better than Q4 the prior year and can make a real difference in your IRMAA calculation. Now, this doesn't always work. It depends on your specific situation, but it's worth annualizing. Strategy number 2, be strategic with Roth conversions. And I think everyone understands when you either do Roth conversions or when your RMDs are coming up, you most likely, if you're a high net worth individual, someone with over $1 million or $2 million in IRAs, you're going to jump in a higher tax bracket. But I think what people overlook, we see all the time, you're gonna be in a higher tax bracket, but that's also gonna increase premiums on your Medicare Part B and Part D premium. So we know Roth conversions are powerful. They let you convert traditional IRA money to Roth, pay taxes on it now, then that money grows tax-free forever. It also has the potential to reduce future RMDs. But here's the catch. A big Roth conversion spikes your income in that year, and that spike triggers IRMAA for the next 2 years. So if you're planning Roth conversions near retirement, we want to think about when and how much. Sometimes spreading these conversions over a certain amount of time will help you stay below when IRMAA increases. And it helps you get the benefit of conversion while minimize IRMAA exposure. A counter argument to that is that if you have a lot of money in IRAs and 401ks, we're talking $3-4 million plus, it may make sense to jump in that next IRMAA bracket because your bigger concern is your future RMDs versus what an annual IRMAA surcharge can be. So you got to weigh the pros and cons to both. It's definitely a balancing act, and it's definitely doable as well. Strategy number 3, filing an appeal, the life-changing event exception. Here's something a lot of people don't know. If your income drops significantly because you're retired, you can actually appeal your IRMAA. You file what's called Form SSA/44 with Social Security. Basically, you're saying, hey, my circumstances have changed. My income wasn't what it was a few years ago, and now I'm retired. If Social Security actually approves it, and they often do, IRMAA premiums can be lowered, sometimes even removed quietly. The key is your current income needs to be significantly lower than the income from 2 years ago. Retirement usually qualifies for that. This is one of the most underused tools that we see frequently. People still don't even know that it exists. Now, here's where it all comes together. When we're working with clients who are approaching retirement, we just don't look at your income taxes. We look at every dollar of income that ripples through the entire plan. We model this out in our planning software. What will Social Security look like, and how can we maximize it so that you are not paying the maximum Social Security tax? When should we claim it? What will Medicare costs be? How will RMDs from IRAs affect our tax brackets? And how will Roth conversions affect IRMAA? Because here's the reality. Income in retirement can affect your federal income taxes, your Medicare premiums, your IRMAA, whether Social Security is taxable, and your exposure to other phase outs, limits, and potential deductions. Let me give you another hypothetical client example. Tim and Tammy. Before planning, they were age 66. Tammy had $1 million in IRAs, and Tim had $1 million in IRAs. They were taking about $50,000 in retirement distributions to supplement with their pension and Social Security. With their income, with that $50,000 withdrawal, they were paying an extra $1,776 per year in Part B premiums, plus $329 in Part D premiums because of IRMAA. Here's what happened. As they got older, their RMD distributions kicked in. Their RMDs from those IRAs went up significantly to around $120,000 combined. That bump in income from their RMDs triggered much higher IRMAA. Suddenly, they're paying an extra $4,440 a year in Part B premiums alone, plus an extra $847 a year in Part D premiums. That's a difference of nearly $5,000 per year just from not managing the timing of their distributions strategically. If they would have planned ahead, we could have potentially used Roth conversions or looked at things like charitable giving strategies or other tactics to manage that income and keep their IRMAA surcharges lower. All right, now let's bring this all home. IRMAA isn't a penalty. It's not punishment. It's just the system that we have to deal with. Medicare uses old data to set your premiums and income thresholds that are lower than what most people expect. But the good news is with good strategic financial planning, you can often avoid or reduce your IRMAA exposure. If you're within 2 years of retirement, now is the time to review your income for the last 2 years. Project what your income is going to look like. Look at strategies like timing your retirement, managing Roth conversions, making sure you're looking ahead at what potential RMDs will do to your tax bracket, or preparing an appeal if circumstances change. Model all of this out and see the complete picture. This is exactly what we do for our clients. We just don't plan for taxes. We plan for Medicare, Social Security, and how it all interconnects so that we make the most use of your money. If you are approaching retirement, and if you want to make sure you are not setting yourself up for a potential IRMAA surprise, that's a conversation worth having. Once again, I'm David Afraimi, co-founder and CEO of BAM Advisory Group. Thank you so much for watching another episode. We hope you find the information very valuable. If you're enjoying this content and want more content just like it, click the like and subscribe button. It also helps us get this show, our content, out in front of more people just like you so they can also get some of this financial education. And if you're wondering if you may have a tax problem, if you're not sure if you have a well-written financial plan, click on the scheduling link in the description to the show and schedule a 15-minute, no obligation, no cost phone call with one of our advisors to see how BAM Advisory Group can help you. You can also visit our website at www.bamadvisorygroup.com and also schedule a call with us as well. Thank you so much for watching. We'll see you on the next episode.